Hi, my name is Wendy Pine. I'm a financial advisor with Protegro at Protegro.com. We're a holistic financial services firm. Today's topic is about fixed indexed universal life insurance, what it is, who would consider buying it, and things to keep in mind. Other variations of this product I'll talk about in future videos. In the last couple of segments, I talked about whole life and term insurance. Whole life insurance is a permanent life insurance policy that pays a death benefit when you die, no matter how long or how soon that may happen. It can build up cash value that you can access potentially tax-free during your lifetime. The rates don't change, and it's built on guarantees. Term insurance is very similar to renting an apartment or even your cable box. You lock in a price for a set period of time, known as a term, which can be as little as a year and as long as 30 years. It only answers the question, if you should die during this particular time period, are you leaving behind people or things that are relying on you? Just like renting, there is no cash value. As a result, if it's designed correctly, this can be an inexpensive policy to buy since most people are going to outlive the term coverage. Yay you. Now, indexed universal life insurance is a permanent life insurance policy that offers death benefit protection when death occurs. And like other forms of permanent life insurance, your premium payments may earn interest and grow the cash value of the policy. What differentiates indexed universal life insurance policies from other types of permanent plans is the way interest is credited to the policy. In addition to declaring a fixed interest rate, indexed universal life also offers the ability to earn interest that is linked to the movement of a selected stock market index over a selected period of time. It's typically the S&P 500 over a period of 12 months. The manner in which interest is credited to your indexed universal life policy gives you the potential for strong cash accumulation. However, unlike being directly invested in the market, you do not get the credit of the full upside of the market. Participation may be limited to either a cap on the gains or just a percentage. For example, let's just say the S&P 500 returned 18% in the last 12 months. Your policy allows you to participate 100% on the upside, but only to a cap of 12%. That's your limit. If the market returned 18%, you can't be credited more than 12%. Or, conversely, there's no cap, but you can participate in 50% of the upside. So to use our prior example, the market returned 18%, but you are now credited 9% because of that 50% participation. For some people, this is a deal breaker, but a key benefit to remember is that even if your gains are limited or capped, your policy offers protection in a poorly performing market, and the credited interest rate is never less than 0% guaranteed. So you don't need to make up for any lost ground. Another key point to know about these policies are that the premiums you pay are never invested in any stocks, bonds, or equity investments, and it does not include dividends on the stocks that make up the index. Please keep in mind that this is still a life insurance policy and that there is a cost to owning life insurance. Policy owners are either using the cash value within the plan to pay for the costs of the life insurance, or they are paying for the premium out of their own pocket, just like any other policy that they'd pay for. You're probably wondering, well, who buys these things? First and foremost, the people who purchase these types of insurance need life insurance, but are looking for an additional or an alternative place to put money aside for potentially tax-free retirement, college funding, a specific goal, or to leverage their lazy money that's just sitting in the bank. Many universal life insurance policy owners are business owners, self-employed individuals, families with children, families who may purchase these policies on behalf of their children, people who have maxed out their retirement plans and would like to diversify their portfolio, or someone who is perhaps more risk adverse but wants more upside potential than what a whole life policy may be able to provide. The downsides of fixed index universal life policies are that they have more moving parts than whole life for term, and are meant for the long term, meaning when you die. They also have premium payment flexibility, which that could be interpreted as either good or bad depending on the person you are. and require either a significant amount of money up front or a consistent cash flow to keep the policy going and running efficiently. It is possible that coverage will expire when either no premiums are paid following the initial premium or subsequent premiums are insufficient to continue coverage. Further, just like other types of insurance policies, making sure that the policy is suitable for your situation and continues to support your needs as time goes on requires at least an annual evaluation from your financial professional. Even with a guaranteed credit of 0 in negative stock market years, this is not what you would consider a buy and hold product. Think about this for a second. You're about to get on an international overnight flight. You buckle yourself in. The captain comes on the radio and confirms where you're going to go, how long it's going to take you to get there, tells you to settle back, relax, and very nicely takes that plane on the runway and into the sky. The captain then puts the plane on autopilot, comes into the cabin with everybody else, takes a seat next to you, and then goes to sleep. Are you concerned? Just like your investments and driving your car, you do not want to put this or other life insurance policies on autopilot and then go to sleep. Don't want to do that. With Indexed Universal Life Insurance, there are a lot of bells and whistles that can be added, like long-term care, chronic illness, or disability benefits. Guarantees are dependent on the claims paying ability of the issuing insurance company, and with that, different insurance companies have different guarantees or cash accumulations and tracking designs. So I'd strongly advise people to work with an advisor who has experience in designing these types of plans, and further that you're comfortable with working with that person for a long time to help make sure that your policies stay on track. For a complimentary guide on how to determine the appropriate amount of coverage for your situation, or you'd like help designing your policy, please email me at info@protegro.com. If you like this and you'd like to see other videos, please hit subscribe below. Go to my website, protegro.com, and sign up for my newsletter. And if you have any other ideas for future videos, please email me at info@protegro.com. I hope you have a terrific rest of your day. This has been such a pleasure. Until next time, thank you.